Hey everyone, welcome back to Finance Unlocked. If you've been following the news, you've probably heard that the Bank of England has cut interest rates. But what does this actually mean for your mortgage, the economy, and what to expect moving forward? Let's break it down. First things first, the Bank of England has reduced its base rate from 4.75% to 4.5%. This is a significant shift, and if you're someone with a tracker mortgage, this is great news for you. You should see your mortgage rate go down within the next month, with lenders expected to update their rates within the next 7 days. But this isn't just a small change. It's estimated that about 700,000 people in the UK are on a tracker or standard variable rate mortgage, so this cut will directly benefit them. If you're one of them, make sure to keep an eye on your lender's updates. Now, the vote on the rate cut was pretty interesting. Out of the 9 members in the Monetary Policy Committee, 7 voted for a quarter-point cut, and 2 voted to keep rates steady. There's also been some talk about potential further cuts in the near future. But here's where it gets a bit tricky. While the Bank of England is hinting at another cut soon, they're cautious. They'll take it on a meeting-by-meeting basis, especially given how unpredictable things are with the economy right now. Let's talk about inflation. The Bank of England has warned that inflation is likely to go back up, partly due to rising energy prices. In fact, inflation could hit 3.7%, much higher than what we'd hoped for. Energy prices are expected to rise again soon, which will continue to put pressure on household budgets. This is particularly bad for low-income families, who are already feeling the pinch from higher utility bills, bus fares, and water costs. Another big concern is the global economy, especially when it comes to tariffs. The Bank of England has highlighted that ongoing tariff uncertainty, especially with the US, could make things worse for the UK economy. We could see more volatility that affects not just consumer prices, but also UK businesses. For instance, UK banks could be impacted by these tariffs as they have global dealings, and this could make it harder for consumers to get the best mortgage rates or business loans. As for unemployment, the Bank of England expects it to rise. Right now, they're forecasting it could hit around 5%, up from the current level of around 4%. This is partly due to economic pressures, including rising energy costs and the impact of the recent budget on businesses. We're already seeing large retailers and supermarkets laying off staff, and that's expected to continue. So, what's next for interest rates? Well, we're currently at 4.5%, and while some experts had initially predicted we might see rates fall to 3.5% by the end of this year, the forecast is now more conservative. By the end of 2025, the Bank of England now expects the base rate to only be around 4%, meaning we may see 2 more cuts. This is due to a combination of factors, including ongoing uncertainty with tariffs and energy prices. One thing the Bank of England mentioned is that a 4.5% rate is still causing financial strain for many households. To really feel like things are under control, we would need rates closer to 2.5%. But with inflation still rising, that seems unlikely in the near future. In summary, while the interest rate cut is a positive development for some, particularly those on tracker mortgages, the outlook for the economy remains uncertain. Inflation is expected to rise, unemployment may increase, and global trade uncertainties are putting additional strain on businesses. So, don't expect many more rate cuts for now. Things are going to stay tough for a while. I'll be keeping an eye on these developments and updating you on what's next. Don't forget to like and subscribe to Finance Unlocked for more finance news and updates. And hit the bell icon so you don't miss any of our videos. See you in the next one.